Protecting your investment account from potential disaster is paramount for long-term success. Many new investors overlook a fundamental principle that can safeguard their capital. This crucial concept is known as the 1% rule in investing. It is a strategy widely adopted by smart investors and professional traders alike. Its primary benefit is to help you avoid devastating losses that can derail your financial goals. This rule is not about predicting the market. It is about managing your risk. In this discussion, we will thoroughly explain the 1% rule. We will explore the compelling reasons why it consistently works for those who apply it. Most importantly, you will learn exactly how to implement this rule in your own investment strategy. Our goal is to empower you to protect your capital effectively. By doing so, you can achieve steady, sustainable growth in your investment portfolio. This foundational knowledge is essential for any serious investor. A common and costly mistake made by novice investors is risking too much on a single trade. They often allocate a disproportionate amount of their capital to one position. This approach can lead to significant financial vulnerability. The consequence of over-risking is severe and often swift. One bad decision can easily wipe out weeks or even months of hard-earned gains. A single losing trade can erase the progress from numerous successful ones. In extreme cases, an account can go from being fully funded to nearly zero in a very short period. This happens when investors lack a defined risk cap for their positions. They are exposed to unlimited downside. This vulnerability stems from a lack of a structured risk management plan. Without a clear limit, emotions can drive impulsive and oversized bets. The 1% rule acts as a crucial safety net, preventing such catastrophic outcomes. It provides a disciplined framework for managing risk. At its core, the 1% rule is remarkably simple yet profoundly effective. It dictates that you should never risk more than 1% of your total trading capital on any single investment or trade. This is a strict limit on potential loss. Let's illustrate this with practical calculations. If you have a total capital of $1,000, your maximum risk on any single trade is just $10. This means if the trade goes against you, your loss is capped at that amount. Similarly, if your total capital is $5,000, the maximum risk you should take on any one position is $50. This small percentage ensures that no single trade can significantly impact your overall portfolio. It is a fixed proportion of your total funds. It is crucial to clarify what risk means in this context. The 1% is not the total amount you invest in a position. Instead, it represents the maximum amount you are willing to lose if your stop loss is triggered. It is your predefined exit point for a losing trade. This approach ensures your account can survive even after multiple consecutive losing trades. Losing streaks are an inevitable part of investing. The 1% rule allows you to absorb these losses without being wiped out. The primary benefit of the 1% rule is its ability to shield your account from catastrophic losses. It acts as a robust defense mechanism against market volatility and unforeseen events. This protection is non-negotiable for long-term success. Implementing this rule forces a fundamental mindset shift. It transforms investing from a speculative gamble into a disciplined risk management endeavor. You move from hoping for gains to actively managing potential losses. This disciplined approach ensures your long-term sustainability in the markets. By preserving capital, you remain in the game, ready to seize future opportunities. It prevents premature exits due to depleted funds. Crucially, the 1% rule enables the power of compounding to work in your favor. When your capital is protected, it can continue to grow exponentially over time. Consistent small gains build into substantial wealth. For any investor, survival must be the first and foremost priority. Growth, while important, comes second to capital preservation. The 1% rule embodies this principle, making survival the foundation of your strategy. While limiting losses is vital, successful investing also focuses on maximizing gains. The 1% rule is a powerful tool, but it becomes even more effective when combined with another key concept. This complementary idea is the risk-reward ratio. A risk-reward ratio helps you assess the potential profit of a trade relative to its potential loss. It encourages you to seek out opportunities where the upside significantly outweighs the downside. This is a proactive approach to profitability. The goal is to aim for favorable ratios, such as 1.2 or 1.3. This means for every 1 unit of risk you take, you aim to gain 2 or 3 units of profit. It defines your profit target relative to your stop loss. For example, if you risk $10 on a trade, you would aim to make $20 or $30 in profit. This structure ensures that your winning trades are large enough to cover multiple small losses. It creates a positive expectancy. This strategy allows for profitability even with a relatively low win rate. You can still grow your account even if only 40% of your trades are winners. The size of your wins compensates for the frequency of your losses. This is a hallmark of professional trading and investing. It involves taking small, calculated risks that have the potential to lead to much bigger rewards. It is about smart allocation, not just high frequency. The core truth of successful investing is that it is primarily about self-management, not market prediction. No one can consistently predict market movements with perfect accuracy. Your ability to manage yourself is far more important. The 1% rule helps you maintain emotional control. It keeps the powerful forces of greed and fear in check. These emotions are often the biggest enemies of an investor's portfolio. It prevents impulsive decisions, such as going all in on a single stock or cryptocurrency. Such bets are driven by emotion, not by sound financial principles. The rule imposes a rational limit. By consistently applying the 1% rule, you cultivate essential traits for long-term success. It fosters patience, discipline, and consistency in your approach. These are the cornerstones of profitable investing. Ultimately, this disciplined framework helps you develop the characteristics of truly profitable investors. You learn to think probabilistically and manage risk systematically. This transformation is key to sustained growth. In summary, the 1% rule stands as the ultimate shield for your investment capital. It is a simple yet profoundly effective strategy that protects you from devastating losses. It is the bedrock of sustainable investing. Remember these key takeaways to apply in your own investment journey. First, never risk more than 1% of your total capital per trade. This is your non-negotiable safety limit. Second, always combine this rule with a solid risk-reward ratio. Seek opportunities where your potential gains significantly outweigh your potential losses. This maximizes your profitability. By adhering to these principles, you protect your capital while simultaneously enabling steady, consistent growth. This disciplined approach sets you apart from the majority of investors. It puts you on the path to financial success. If you found this information valuable, please consider liking this video. Your support helps us reach more beginner investors who can benefit from this crucial knowledge. Share it with anyone who needs to hear this message. For more in-depth lessons and practical investment strategies, subscribe to Online Investment Compass. We are committed to providing clear, actionable advice to help you navigate the markets. Join our growing community of informed investors. We also encourage you to leave a comment below. Share your thoughts on the 1% rule or ask any questions you might have. Your engagement helps us create even better content for you. Thanks for watching.